Welcome, this is Dimo Gonzalez of Heartwood Financial Services. In today's video, we're going to get into some of the latest events, and there's been a lot going on, and some of the ramifications of those events. So I'm glad you're here. Let's dive right in. Alright, so let's get right into the asset class returns as of the end of March. So as you look at this chart, the first thing that's drawn to your attention is everything is pretty much above the zero. There's just a few exceptions. So for quarter to date, we've actually had a pretty good stock market and bond market. A couple highlights, you can see the U.S. stock market, mostly the large cap stocks have been doing pretty good. You see the small caps have started to take a little downturn recently. And we'll talk a little bit more about that later, as well as real estate. But the ironic winner for the quarter is developed international stocks, up 7.7% quarter to date. And of course, fixed income has done pretty well, and commodities have actually done not too well, except for gold. Gold is part of the commodity complex, but commodities in general, which includes a lot of energy and other commodities that are more agriculture, have been coming down. So those are the asset class returns. Now let's get into the update. Alright, so the big event that happened in March was the bank failures. And you guys have probably all heard about Silicon Valley Bank. And so I'm not going to rehash every aspect of that story. I did a whole financial education video. I encourage you to check it out. It was actually one of our most viewed videos. And so what I want to talk about here is that there's going to be some shock waves, I believe, from what happened. I believe that what happened was a pretty big deal and may not be completely over. I think the risk of more bank failures have definitely gone down, especially since the government and the Treasury came together and they put some stopgaps in, some programs to help the banks going forward. But the problem that the Fed created is still there, so I think there's going to be some ramifications that we're going to talk more about in the outlook. Alright, normally the biggest event that would have happened for the month was, would have been the CPI report. That's the Consumer Price Index. That's what's measuring inflation. And you know, if you've been watching my videos over the last year and a half, that's almost been the number one topic. And so the last report came out a little better than expected. Now we have inflation at 6% year over year. And it was actually a nice little drop from the previous month. And the month over month number was also a little bit of a drop from the previous month as well. So things are moving in the right direction, and the leading indicators of inflation also show that inflation is most likely to continue to come down. And frankly, with what happened to the banks, that's probably only going to make inflation come down even faster. Again, I'm giving you lots of previews to the outlook. Now, with inflation coming down, you would have thought that the Fed would have been really happy about this. And I think secretly they are. They're just not letting people see it because they want to still talk pretty tough, because inflation's still 6. It's not 2%, which is their target. So they're trying to bring it down. So what happened is they raised interest rates again, another 0.25%. Now we're at 4.75 to 5. It's always this little range. And so now we're basically touching 5% on the Fed funds rate, and that is going to, again, produce more gravity against the economy. And it seems like it's starting to work. We're seeing that inflation rate go down. Now, I think, especially because of what's happening with the banks too, I think they're realizing that maybe they've gone a little too far too fast. I hope at least that's what they see. And I think they may be very close, if not already, at the end of their Fed rate hiking cycle. So that's going to have a lot of ramifications that we'll talk more about in the outlook. right, now in the market outlook, thanks for staying tuned here. I've been teasing for this outlook for most of the video. The first piece that I want to talk about is what I believe is going to happen. And now with some of these bank failures and the Fed raising rates the way they have, I think what's coming up is what's called a credit crunch. Basically, it's just going to be a lot harder to get credit, or credit's going to get a lot more expensive. So let's talk about why I think this is going to happen and some of the ramifications. Alright, so let me explain to you what's going on underneath the hood so that you understand why there potentially is going to be a credit crunch. Now, the first thing is obvious. The Fed has been raising interest rates. That raises the price of money that banks have to lend to each other when they, have excess money and another bank needs money. And so that just raises the price of money also for consumers. The second part is with this illustration here. This is a typical balance sheet on a bank. Okay, so banks take in deposits and they use the deposits to make loans and other things. But I just want to focus on this one part because I think this is the key part. As the Fed has been raising interest rates, there's been a lot of other attractive options out there like T-bills or just money market mutual funds that are available at much higher rates than what the banks are willing to pay. So a lot of people have been taking their money out of the banks and out of their deposits. And so what's going to happen is that then there's going to be less money for the banks on the other side of their balance sheet to make loans. So not only now do you have rates going up, but now you also have less money for the banks to make loans with. And so when you combine these two things, it's going to make the banks really tight with their money, and I believe this is what's going to cause the credit crunch. What I don't know is the ramifications and how big this can be. This certainly doesn't look like anything like 2008, but with the next slide I'm going to show you what are the specific ramifications I think it could have. Now here is an example of one of the ramifications, and I think there actually could be more than this, but I'm going to highlight real estate here. And what I want to show you here is lots of commercial real estate. It has to be refinanced on a regular basis, and a lot of the loans were done several years ago and are starting to come to maturity, which means they either need to be refinanced or paid off, but usually they're refinanced. And what I want to point out here is here we are in 2023, and it looks like a tidal wave of matured loans that are coming due in the next 3 or 4 years in real estate, and a big part of that being office. And if you think about what's been happening after the pandemic, people have not been all going back to the office. They've been coming up with different ways to work from home or even a hybrid. And so this is going to all come to a head, I believe. And I think as these real estate loans come due, a lot of these real estate owners may not want to refinance or won't be able to refinance because the rates are higher, and the banks, are not going to be super willing to lend because they're getting crunched on their deposits, remember from the last slide. So I think this could be a problem, especially for the commercial real estate market, but also for corporations in general, and probably for autos too, but I'm highlighting here the commercial real estate. Alright, so here I want to discuss the flip side of the situation, which is what the market right now is battling with. This credit crunch a lot of people are seeing, and that again increases the odds of a recession. But what's the flip side? Well, if the Fed really is pretty close to peak in their interest rate hikes, what does history show that happens to the market shortly after that? So I wanted to show you this chart here because you could see 3 months, 6 months, 12 months, and 24 months after peak rates, which is pretty much where we're at right now, we see very strong returns in the S&P 500. And so what's going to win out? Is the recession going to be worse than people think, or is the comeback in the stock market because we're not pulling away, liquidity and we're going to let interest rates maybe stabilize and potentially even come down a little bit, going to help the market more? That's the question I don't know how to answer. Definitely a little bit more on the cautious side at the moment, because I do feel like this is going to start making a bigger effect maybe towards the second half of the year. And in the last slide, I want to show you some specific implications to what I've talked about here in this video today. Alright, the last slide here, as always, are the Heartwood implications. Overall, we're playing things a little bit more cautious, but also knowing that things could turn around maybe in the second half of the year. But for right now, we're reducing small caps, adding to some more of the larger cap, more growth-oriented names that tend to do better when things are slowing down and when interest rates are stable and going down. Reducing financial stock exposure. Okay, that makes sense based on what's been going on with the banks. Adding a little bit more to the quality bonds, reducing some of the preferred stocks, which really are kind of like bonds, but they're issued by financial companies, usually banks. Also reducing our real estate exposure through REITs. We usually have a position there, so we're cutting that down. They've already adjusted quite a bit, so we're not reducing them entirely, but just cutting it down and adding a little bit more to higher quality bonds to, kind of get ready for things to get a little rockier here maybe in the second quarter before things turn around. So I hope this was helpful. If you have any other questions, please feel free to reach out. Be happy to go into any more detail if you like. But thanks for watching, and God bless.